You can be 100% right on a stock's direction and still lose 50% of your money with options. Here is the math behind why that happens. Most new traders rush into options because they offer cheap leverage. They see a way to control 100 shares for a fraction of the cost. But this capital efficiency comes with a hidden rent payment that stock owners never pay. Let's look at the upfront capital comparison. Buying 100 shares of a $150 stock requires $15,000. Buying one at-the-money call option might cost only $500. This looks like a 30x leverage advantage, but the mechanics are deceptive. The first trap is the break-even hurdle. When you buy stock at $150, your break-even is $150. If the stock stays flat, you lose nothing. With an option, you start the trade with an immediate realized loss equal to the premium paid. This means the stock doesn't just need to go up, it must go up fast enough to cover the premium. This introduces the concept of time decay, or theta. Stock has zero theta risk. You can hold it forever. Options have an expiration date. Every day that passes, the option loses value even if the stock price doesn't move. This decay accelerates as you get closer to expiration, creating a use-it-or-lose-it scenario for your capital. This leads to the second major trap, volatility, or vega. When you buy options, you are technically buying volatility. You need the market to move. If you buy an option when volatility is high, you are paying a premium price. If implied volatility drops, known as IV crush, your option can lose value even if the stock price goes up. This often happens after earnings reports. Stock owners are immune to vega risk. They only care about price. So, when does buying options actually beat buying stock? The answer lies in convexity. Stock returns are linear. Option returns are exponential. You use options when you expect an explosive move in a short time frame. We also use options for defined risk. If you buy stock at $150, it can theoretically go to zero. If you buy a call for $500, the most you can ever lose is $500, even if the company goes bankrupt the next day. This brings us to the leverage calculation. Calculating your effective leverage helps you understand the true risk. Often, traders are levered 50 to 1 without realizing it until a small pullback wipes them out. To visualize this, imagine a 2% drop in the stock price. The stock owner loses 2%. The option holder, due to leverage and delta, might lose 30% or more. Leverage works both ways, magnifying losses just as fast as gains. Now, let's build the decision framework. You should choose stock when your thesis is long-term, slow growth, or dividend collection. In these scenarios, time decay and volatility drag will destroy option returns. Conversely, choose options when your thesis is based on velocity or a specific event. If you expect a 10% move within 2 weeks, stock is too capital-intensive. Options provide the necessary acceleration. Let's summarize the delta rent concept again. Think of the option premium as rent paid for the privilege of leverage. If the stock appreciation doesn't exceed the rent, you are losing money every single day. Another factor is liquidity. Stocks are generally highly liquid with tight spreads. Options, especially on smaller companies, can have wide bid-ask spreads that eat into your profits immediately upon entry. You must also consider the psychological cost. The volatility of an options P&L can lead to emotional errors, like panic selling during normal market noise. Stock allows you to weather storms more comfortably. However, options allow for legging in. You can buy a call, wait for a move, and then sell a higher strike call to turn it into a spread. This flexibility to adjust risk is something stock cannot offer. Here is your final decision tree. Before every trade, ask, do I need leverage? Is my timing precise? Am I willing to lose 100% of this capital? If the answer is no to any, buy the stock. Remember, the goal isn't just to make money when you're right, but to keep your money when you're wrong. Stock is forgiving of timing errors. Options punish them mercilessly. Use this framework to stop renting risk when you should be owning assets. In the next video, we'll discuss how to use stock and options together in the covered call strategy. Choose options for velocity, choose stock for certainty.